Intro, the invisible tax on your dividends, $3,000 just vanished from your dividend portfolio this year. And inflation is the culprit most investors ignore. Here's what's happening. You believe your dividend yields are locked in. You think a 5% yield on a $100,000 portfolio means $3,500 in income year after year reliably. It's straightforward math, right? But according to Bureau of Labor Statistics data, inflation averaged 3% annually from 2020 through 2022. Then in 2023, inflation ticked back up to 1% according to year-end CPI reports. That means your purchasing power on that $3,500 was eroding at roughly $3,000 per year and lost real value. You're earning the income, but your ability to buy the same goods and services keeps shrinking. This isn't theoretical. This is happening to millions of dividend investors right now, and most don't realize it's costing them thousands annually. The real VS, nominal return problem. Let me break down the math more clearly because this is where most investor education fails you. Nominal return is what your brokerage statement shows. 5% on $100,000 equals $3,500. Simple. But real return is what matters for your actual purchasing power, and that's calculated by subtracting inflation from your nominal yield. So if you're earning 5% nominally, and inflation is running at 3%, your real return is only 5%. That's the difference between $3,500 in cash and maybe $500 in actual purchasing power gains. Dr. Jeremy Siegel, finance professor at Wharton, has documented extensively that ignoring inflation costs retirees an average of 15-20% in total wealth over a 30-year retirement period. That compounds dramatically. On a $100,000 portfolio, that's potentially $15, $20, $000 in lost purchasing power over 3 decades, just from dividend income alone. Here's a concrete example. In 2021, a dividend investor bought $100,000 in a popular high-yield dividend ETF yielding 8%. They felt comfortable withdrawing $3,800 annually. But 2022 saw inflation hit 73%, the highest in 4 decades. That $3,800 that bought a certain lifestyle in January 2022 could only buy about $496 worth of goods by December 2022. That's a loss of $304 in purchasing power in just 12 months. Over 5 years at average 4% inflation, that same $3,800 annual withdrawal loses approximately $748 in cumulative purchasing power. Historical case study, 2020-2024. Let's look at what actually happened to dividend investors during the recent inflationary period, because the data tells a sobering story. From January 2020 to December 2024, inflation has been highly volatile. 2021, 4% 2021, 7% 2022, 67% 2023, 1% 2024 through November, 6% cumulative inflation over this period, approximately 23%. Now imagine you owned a portfolio of traditional dividend stocks paying 5% average yield. Your cumulative nominal returns would be around 5% times 5 years. But your real returns, adjusted for inflation, would only be about -5%. You actually lost purchasing power despite receiving thousands in dividend checks. Consider a real case, AT&T, classic Dividend Aristocrat, traded around $30 per share in early 2020. A $30,000 position paid roughly $3,600 annually in dividends, 5% yield. An investor felt secure. But let's track what happened. 2020, $3,600 dividend received 4% inflation minus 2021. Dividend increased to $3,708 plus 3%, but 7% inflation exceeded the raise minus 2022. Dividend increased to $3,820, but 8% inflation made this income worth significantly less minus 2023. Further increases still lagged inflation. By end of 2023, that investor had received approximately $18,500 in cumulative dividends on the $30,000 initial investment. Sounds decent. But the real purchasing power of those cash flows, inflation adjusted, was approximately $17,200, a loss of about $1,300 in real value. And AT&T stock itself had barely moved, trading around $27 by late 2023. The counter-argument, dividends grow, so inflation doesn't matter, you might argue. Wait, dividend-paying companies raise their payouts over time. Dividend aristocrats increase payments annually, so inflation gets beaten. This is a partially correct argument, but with significant limitations. Yes, companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola have consistently increased dividends. But here's the catch. Dividend growth lags inflation roughly 30-40% of the time. During the 2022 inflation spike to 8%, the average dividend increase across S&P 500 companies was only 5-6%. Companies can't increase payouts faster than earnings grow, and earnings growth often lags inflation during inflationary periods. Moreover, you're relying on management decisions outside your control. A recession, earnings decline, or strategic shift can freeze dividends entirely. During the 2008 financial crisis, dividend cuts exceeded dividend increases, the exact opposite of what you need in an inflationary environment. 3 dividend ETF strategies that actually beat inflation. So how do you structure a dividend portfolio that outpaces inflation? Here are the 3 most effective strategies backed by historical performance data. Strategy #1, dividend growth F, not just high yield. The biggest mistake is chasing yield numbers. A 5% yield sounds great until inflation runs 4%, and your real return is 1%. Instead, focus on dividend growth ETFs like VIG Vanguard Dividend Appreciation or DGROW iShares Core Dividend Growth. These funds hold companies that have increased dividends for 10+ consecutive years. They currently yield around 5%, which sounds lower. But here's the magic. Their historical dividend growth rate averages 7-8% annually, well above long-term inflation rates of 5-3%. Case study. An investor put $100,000 into VIG in January 2020 at a 3% yield, generating $2,300 in year 1 dividends. They had $2,300 of dividend income. By January 2025, due to consistent dividend growth from holdings, that same $100,000 position was generating approximately $3,200 annually, a 39% increase in income from the same capital. Inflation over this period was 23%, so real income actually grew about 16%. This is the opposite of the eroding purchasing power problem. Strategy #2, inflation-protected dividend hybrid combined dividend equity ETFs with treasury inflation-protected securities. Tips adjust principal based on CPI, providing a guaranteed inflation hedge. Many investors overlook them because yields seem low currently 4%, but you're not chasing yield, you're protecting it. A 70/30 split, 70% in dividend growth ETFs, 30% in tips, historically delivers 4-4. 5% blended yield while maintaining inflation protection on a third of capital. This is less glamorous than 5% yields, but more reliable over 10-20 year periods. Data. A Vanguard study, 2023, showed that portfolios with even 20% tips allocation outperformed pure equity dividend portfolios during high inflation periods by an average of 1% annually. Over 20 years compounded, that's a 46% larger real return. Strategy #3, sector rotation dividend strategy. Inflation affects sectors differently. Energy and utilities historically perform better during inflationary periods because they can raise prices and pass costs to consumers. Healthcare and consumer staples also hold up well. Financials can suffer if inflation leads to recession. Rotate your your dividend allocation quarterly based on inflation expectations. When inflation is rising, overweight energy, XLE, VDE, and utilities, XLU, VPU. When inflation is declining, rotate to tech and growth companies that also pay modest dividends. Data from Morningstar, a tactical sector rotation strategy from 2020-2024 generated 7% real annual returns versus 2% for static high dividend portfolio. That's 4x the inflation adjusted performance. Yield maximization tactics, adding $1,000 plus annually now. Assuming you implement one of those three strategies, how do you squeeze an extra $1,000 in annual income from a $100,000 portfolio? Tactic hash 1, covered call writing 20% annual yield boost. If you hold 500 shares of VIG, you can write covered calls against that position quarterly. Writing one call contract, covering 100 shares at 1-2% out of the money typically generates $50-150 in premium per quarter. Across 5 call contracts, quarterly across your position, that's $200-600 annually in additional income. Warning, you risk shares being called away if price rises significantly. But if your goal is dividend plus modest capital gain income, this works well. Real case. An investor wrote calls on dividend ETFs for 3 years, 2021-2023, generating an average additional $240 annually. Tax-efficient income. Tactic hash 2. Dividend capture strategy. Some investors buy dividend stocks 1-2 days before ex-dividend dates and sell after collection. This works for funds with monthly or quarterly dividends. On a $100,000 portfolio, entering and exiting high dividend positions 8-12 times annually for the dividend capture can net $300-700 in additional annualized income. Note, transaction costs and taxes reduce net benefits. This works best in tax advantage accounts era 401ks. Tactic hash 3. Preferred stock allocation 0. 5-2% extra yield. Preferred shares sit between bonds and common stock. They usually pay 4-6% yield, currently higher with elevated rates. A 10-15% allocation to preferred ETFs, PFF, PSB, adds 0. 4-0. 8% overall yield, which on $100,000 is $400, $800 annually. Trade-off. Preferred shares have less capital appreciation potential, but for pure income maximization, they're underutilized. Tactic hash 4. Selective closed-end fund holdings. 1-3% excess yield. Closed-end funds, SEF, often trade at discounts to NAV and pay distributions of 6-8%. ETFs like DJP or WPC provide higher income. A small 5-10% allocation generates the $300-800 additional annual income needed to reach $1,000 extra. Risk CEF discounts can widen, reducing capital value. Use these tactically, not as core holdings. Conclusion. Close the belief gap. The belief that a 3-5% dividend yield is safe, predictable income is costing you real purchasing power. When inflation runs 3-4%, your real yield is negative or barely positive. By shifting to dividend growth strategies, implementing inflation hedges, and using yield maximization tactics, you can 1. Beat inflation by 5-3% annually, real returns. 2. Generate an extra $1,000 annually on a $100,000 portfolio. 3. Sleep better knowing your portfolio income will actually grow, not shrink. Start by evaluating your current dividend holdings. Ask, are they growing?